All right, good morning. Welcome back here to Trader Minute. Great to have you aboard. One publication on Friday read market set for smooth sailing this summer as trade war comes to a close, U.S. jobs increase, and economic weakness is behind us. Yeah, maybe a little premature, right? Maybe a little premature. And on Friday, yeah, maybe it looked like that, right? We had the market took off on Friday. Here's the hourly chart of S&P futures. We had the Fed, and then we had jobs report, and market closed at a high. Everything's great, grand, and wonderful. And then you can kind of see where the market's opening up here today. All the way back down here, down about 50 points as it sits right now. And look, you don't have to go very far in terms of market headlines to find out what's going on. U.S. President Trump took to his Twitter account this weekend and promised more tariffs on China. Not a whole lot more. Really, just kind of reiterating some of the threats that were already out there that have been pushed back, but brings a lot of questions of whether the trade war is over or whether it's still going on, or is there going to be a solution? We have Goldman Sachs out this morning giving their best commentary on it, talking about the chance of not getting a trade deal is about 40%. So they still think there's better odds of a trade deal than no trade deal. But we have some Chinese delegates that are supposed to arrive here in the U.S. on Wednesday. And all market eyes are going to be on whether they come over or not. And right now, one of the big problems for the market is there's a little bit of a media blackout here in China and the U.S., right? U.S. President Trump doesn't go through traditional media outlets here in the U.S., and in China, there's, not a whole lot being allowed to circulate in the media. So, the ability to gather, the pertinent, relevant news is pretty slim, and a lot of that's just because it's still ongoing, right? It's still happening. It's not like there's a absolute as far as what's going to happen. But we saw China overnight plunge. In fact, the Shanghai Composite was down 6%. The FXI, you can see, set to gap down very big here today. China came out last night and they injected some liquidity into the economy. That's not on the front pages out there this morning, but we did see China do that to try to support things a little bit as the markets tumbled there. We saw the Hang Seng, or there in Hong Kong, down about 3%. And get quite rattled here. We've seen Europe. Let me pull up Europe here for you. I made the comment last week that for U.S. market equities to go on a correction, we need to see Europe have one of those kind of just big sell days. We're having a big sell day in Europe, down about 1.8% across the board. Definitely some sell action going on there, and something to pay attention to for sure. But anyway, bottom line, U.S. President Trump tweeted, and markets are down, and now there's a lot of questions being asked, and there's not a lot of answers, right? We think about when markets' path of least resistance is higher or lower. Path of least resistance is higher when there's more answers than questions. Path of least resistance is lower when there are more questions than answers. And the market had been looking and saying, all right, trade war behind us. We're going to get a deal. It's inevitable we're going to get a deal, right? And now, not so much, right? Not so much. It brings this kind of question of bond traders versus stock traders and who's right. And historically, bond traders are always right, and stock traders, tend to be wrong. And we have seen this has been one of the biggest divergences between what the bond market is saying and what the stock market is saying over the last 3 months. Bond market looks very intelligent right now, right? Bond market looks very smart. Stock market looks pretty foolish. A lot of egg on its face here this morning with this action. Now, one of you emailed me early this morning and asked what technical indicator is there that would suggest on Friday that we would wake up to a big gap down today. I promised I'd respond on this video, but the answer is very simple. There's not. Right? There's not a technical indicator that would say, oh, today we're going to have a big gap down, right? That's not a technical element. That's a that's a market element. That's a news element. We've talked about the divergences in some of the indicators and some of the weaknesses in, some of the other elements of the market. But a lot of those arguments, they've been here for weeks, for months. Right? And those same arguments were still here, and the market did gap down big. To say, well, on Friday, at the close of the market, I know the market's going to gap down big on Monday. Well, you probably need to be in U.S. President Trump's absolute inner circle or be very speculative and have been very speculative for a long time, right? That's it. That there's not a magical technical indicator. It's one where the MACD has continued to go down here as the market has gone up. But look, that's been something that's been going on for a while. That's nothing brand new. There's not an absolute indicator that shares these types of things. But when we see something like this happen, it creates significant levels in the charts. That's what I expect to see happen today. I would be very surprised. If we see market buyers willing to chase this market back up over last week's highs. I'd be very surprised if we see that. Dip buyers, they'll have a chance to come in. But are they going to have confidence to drive this market back and above into new highs? In order to get that, they better have a signed trade deal and some absolute strengthening in economic data. Those two things are going to be needed now. The market, some of this confidence that the market gained here in the last 2 months, right? We talked about some of the forced fund manager entrants here in January, February. Market gained confidence here in March and April. Now, a lot of fund managers are going to wake up upside down here this morning and are going to have a lot of questions to answer and are going to have to react to things. Will we see a buy the dip type element come in? Yeah, we will, but I do think we'll see much more sell the dip than buy the dip as we go forward here. There was also a publication on Friday talking about the yield curve. The yield curve is inverted, and so means stocks are going to go down. We're looking at this inversion, and things are in trouble. Well, let me show you the Treasury data here from Friday, where it's at. Here's May 3rd, right? An inverted yield curve is when the back end of the curve is lower than the front end of the curve. Well, the 1-month Treasury yield 2.42, back end 2.93. There's no inversion in terms of the absolute front and the absolute back. There are minor inversions in the middle. 6-month is 2.46, right? 1 year, 2 year, 3 year, 5 year, and 7 year are all lower than the 6-month. In fact, they're all lower than the 3-month. We are seeing inversion. There is an inversion within the curve, but when you take the back three rates and compare them to the front 3 rates, we're talking about a pretty flat curve, but it's still not inverted, right? Still not inverted there, and this is nothing new. We have seen this for a while. This is not anything that changed last week or anything that is changing today. We do have inversion in the yield curve. in the middle of it, but we don't have that kind of absolute inversion where the back end's lower than the front end of it. Okay, so that's what's going on here this morning. Right, that's what's going on. We had the VIX up very big here this morning. Notice gold down $2. Right, why? Well, U.S. dollar's up. Right. So we talk about gold. It's not a fear trade. It's not one of those things to buy if you think the market's going to drop. Gold is not protection against a downside market. Gold is a currency. Gold is in the way that it trades, in the way that it moves, is absolutely a currency there. Keep an eye on some of the high yielding stocks. Some of your AT&Ts of the world today. You start to see the high yielders, bounce this morning. That'd be a sign that, hey, you know what, the market, they're still kind of buying into things. But if high yielders can't hold up here this morning, it'll be very difficult to see some of your more speculative names like your Alibabas and your Microns and your Boeings, really hold up, here at all today if we don't see some of those higher yielding names really start to claw and climb back here in this market. There's going to be a really ugly open for some industrials like a Caterpillar, some industrials like a Honeywell, Triple M. It's not going to be a pretty morning. It just is not going to be a pretty morning for them as investors run and investors kind of move on out with this monster gap. Because let's face it, right now we're not talking about investors. They haven't had a chance to sell this, right? Investors are waking up. Their values, the stock values, were where they were at Friday's close. They're waking up and the values are significantly lower this morning. They didn't get there because somebody sold them down and they had a chance to get out. No, those values changed literally overnight. And this is one of the biggest gaps that we've seen in the market this year. In fact, I believe it is the biggest. I have not verified that, but I do believe it is the biggest gap so far this year. In terms of gap down, just looking at things, maybe this one gap here in January, one of these two gaps was a little bit larger on a percentage basis. Some things that may be close, but definitely this one is one of the largest that we are seeing out there. Okay. Now, with everything going on here this morning and some of the stuff, that I have a few positions on the board. I've talked about them, the cats and the banks and things like that. I do want to, I am going to be kind of engrossed in the market for the first hour and a half here. And then afterwards, I'll jump on video. We'll go and we'll take a look at our next indicator on our technical indicator series. I may change up the indicator we go look at. May look a little bit more at an indicator that may model or fit into gap action like what we see here today. So may just switch the indicator we look at today based on the overall market. And then we'll be talking about later today the new and upcoming 100K challenge. That will get started here on Thursday. Looking forward to that for sure. And we'll talk about that later on here today as kind of the market settles out. As some things kind of come up here this morning, we'll jump on and take a look at them. It is one where, look, I mean, the gaps are the gaps. This isn't a gap where I think you can wake up and say, oh, well, automatic, just buy the gap. I think if you hear Chinese trade delegation is still coming on Wednesday, if you see that report come in on one of the news wires, boom, you can go buy it and buy that for a good 20 points, would be my suspicion. But if without that, I think the markets are going to be left to languish here a little bit. Today is, some forced selling's going to come in. Whenever we see a gap at this size, there is some forced selling that has to come in. Keep an eye on some volumes. We may see some bottoming volume come in on S&P futures. That would be common on a day like today, but it's an ugly open for sure. For the Bulls, and it's an open where if you look at the market, I know we're in this big bad bull market, but it's an open where equity investors, this open leaves them at what here's today's Monday, last Monday, 2 weeks, 3 weeks, 4 weeks. This leaves them over a month with no gains, right? That's a different environment than what we have been sitting in here for quite a while in the market. Thanks for hopping on. Have yourselves a great one, and we'll talk to you later. Take care.